welcome to Indianomics. The third quarter results of banking companies have brought into public a dirty secret that everyone knew. The large amount of non-performing loans or NPAs in the banking system, that is loans that are not being paid back by the borrowers. Sensing that banks are hiding this problem, the Reserve Bank 18 months ago asked banks to report to a newly created central database all loan accounts where interest is not being paid in time. With 3 or 4 quarters of data collected, the central bank was sure of the weak borrowers. It ordered all the banks to recognize as NPAs a bunch of large accounts where interest payments are routinely delayed or whose projects are stranded. Until September 2015, the average non-performing loans across banks was just 5.1%. But this quarter, the average NPA for some banks like Dena, Bank of India, PNB, IDBI is up between 8 and 9%. And for banks like Canara, Allahabad, Andhra, Union and State Bank of India, it is an average 5 to 7%. Looks like at the end of the third quarter, average bad loans for the system as a whole will rise to 7% from 5.1%. That's not all. Most bankers have said the bad loans may see a similar jump in the fourth quarter. These revelations have led to a scare in the country about how many bank loans won't be paid back, and hence how will these banks survive and lend in the future. To answer these questions, I have with me 3 experts: Anil Agarwal, Head of Asian Bank Research at Morgan Stanley; Anando Bhowmick, Chief Analytical Officer at India Ratings; and Dr. K.C. Chakraborty, former Reserve Bank Deputy Governor and also former Chairman and Managing Director of Punjab National Bank. Gentlemen, welcome. Let me state at the outset that we are discussing only the public sector banks. 1, because the problem is more acute here, and 2, because taxpayers' money is going to be used to make good their losses. Anando, let me begin with you, since as the debt expert, you're going to be looking at the bank books from a very long time in terms of how much will come back. Going by what you know about the corporate sector at India Ratings, where does the public sector GNPA stop at? At 12%, at 13%? What are you preparing for?
I think we've already articulated, and everybody knows this, a total stress number of about 12%, which is well known and I think factored in. I think where these surprises are coming from is, of course, another 5 to 6% in the corporate side, which are currently classified as performing for various reasons and are not provided for at all. And these are assets, these are loans, exposures in sectors that are obviously under stress, metals primarily, and our sense is that they would probably need some haircut. So a double-digit number, I think, is a given. It's really the additional provisioning that people are concerned about, and really where that leads to is what sort of internal capital would these banks be able to generate, and whether they would have sufficient capital, any capital left at all for growth. Okay. I think that's the question we're grappling with. Okay,
I'll just come back to you for your estimates on all these, on the extent you expect the government to provide and the extent you think the banks can garner for themselves. Anil Agarwal, similar question to you. A blanket question on the public sector bank numbers. We've got bulk of the public sector bank numbers for this quarter. Is your sense also, like Anando says, that the total GNPA, gross non-performing assets, will be about 10% of the total book, or will it be even worse?
So Latha, we look at total impaired loans, not just gross NPLs. So if I look at quarter back, the total impaired loans in the state-owned banks was about 14%. There are banks which are running at almost 20%. That 14% will probably go up by at least 300 to 400 basis points over the next 2 years. We also did a stress test recently where we basically built in a scenario where it goes up by about 800 basis points compared to where we are right now. So I think that 14% is definitely going to go up materially. Whether it goes up to 16, 17 or 21, 22, we need to wait and see how the economy recovers.
Well, going by the pace of recognition and the kind of recognition that banks have done in the just concluded results season, what do you think will be the recognized GNPA by the end of, say, March? Anil?
Recognized GNPA, so if you look at the AQR for most of the banks which has come in, because the hits because of AQR, it's about 2 to 2.2%. If you add up 1 more percent, so I guess the gross NPL ratio will probably for the state-owned banks as a whole will probably increase by around 2 to 2.5% between December and March quarters.
No, I'm trying to get that figure of the gross NPA, because ultimately provisioning will have to be done on stated NPLs, not on expected NPLs. So if that is the case, what kind of a capital requirement do you envisage for the state-owned banks for FY17?
Yeah. So, Latha, the question is, so what we do is that we look at NPLs, we look at restructured loans, because if you look at the flow of restructured loans right now for the last couple of years, a large chunk of the restructured loans are turning bad. And what we do is we look at the restructured loans which are coming out of restructuring, and 60% of those loans are actually becoming NPLs.
It's only between about 30% at worst, or 40% at worst of the restructured loans that have become NPLs. So should you count the entire restructured book as potential NPLs?
No, we don't count the entire restructured book as potential NPLs. Actually, if you look at the loans which are exiting the restructuring process, most of the banks are right now reporting 60 to 80% of the loans which are exiting restructuring process becoming NPLs. Because if you look at 20 to 30% on the outstanding stock, that's not the right number, because a lot of these restructured loans have moratorium periods of 2 years, 3 years. Right. So you need to look at what is coming out of restructured loans. When it comes out of restructured loans, is it getting upgraded or downgraded? And depending on the bank, this quarter is different because of the SDR stuff, because most of the restructured loans are being, whatever is exiting is basically going through the SDR process, so they will become NPLs 2 years later. But if you look at the exit from restructuring, and that's the key number in my view, 60 to 80% of all the exits from restructuring are turning bad. And that applies to private and state-owned banks. Okay. So a lot of restructured loans are turning bad, as a result of which, when the time comes, they will have to make provisioning on those restructured loans also. So in my view, the state-owned banks, if I assume that they need to achieve 9.5 to 10% CET1 ratio, they need to grow the loan book at anything between 7 to 10%, depending on how small or big the bank is, then to achieve that kind of Tier 1 ratio by March 19, which is the end date of Basel III, state-owned banks will need about $40 billion of capital. Okay. And the thing is, the more the delay in capital infusion, the bigger the hit will be, because that means these banks are not able to grow, so more corporates will turn bad. So it's not a static number, it'll keep growing. Okay.
That's a sizable amount of money that you're asking for in terms of capital. In terms of lakh crores that Indians understand, it would be about 2.5 lakh crore that you are talking of in terms of capital. Anando, what's your bill? And I want to know more the FY17 bill.
FY17 is going to be relatively modest. You see, the complication here, Latha, is you discussing provisions. It's not so much as what the addition to the reported NPAs are, but the other complication has been that this year, and rightly so, I think, some of these recognitions are being provided for as if they are in the doubtful category. So RBI has required them to be classified from the day they went under stress and not from recognition. So therefore, some of these recent recognitions are requiring higher levels of provision, which I think is what they should be. The 17 requirements are relatively more modest, but 18 and 19 are significantly stepped up. At 17, I think, depending upon which way you look at it and sort of growth numbers you look at, we sense a requirement between 25 and 30,000. That sounds modest. The question is, there's also 100,000, 1 lakh crores of equity contribution by the government. Okay. So I'm just looking at what the government is required to contribute. On top of that, there's an additional 25,000 that the banks need to raise by way of AT1 capital. So somebody's got to find a market for that. If that is not supplied in, then obviously that would probably need to be contributed as by way of equity. And then, of course, there's a balanced 20-25% number which is expected to be raised to the markets, equity markets, which is not supportive at all. And so therefore, in terms of the actual billing, the number may actually double from what the ask is. Okay. And this is without even considering the additional provisioning that may be required from the bottom-up study that we did, which suggests that there's an additional haircut that the banks need to take on some of the currently performing numbers. Okay. So the bill is going to mount up, Latha.
Well, okay, let me look at what the equity market is expecting. If the budget were to indeed say 25,000 crore or 30,000 crore, Anil, how inadequate would that be? What is the number for FY17 that you want the budget to say in terms of recapitalization?
So again, we don't have a budget number per se that we have published, Latha, so I can't talk about that per se. But as I said, I mean, following on Anando's point, because he's breaking it down into 3 years, my view is that the total bill is a big number. If I look at any of the banking slowdowns or banking sectors which have gone through an NPL problem in the past, the out for the banks, or the bank stocks, really started performing only when the investors were sure that the balance sheet is taken care of.
Yes.
The share count is fine. So if you look at US banks in 2008-2009 crisis, there was a massive capital infusion, one shot. I mean, there were a number of capital infusions through 2007 and 2008, but towards the end of 2008, there was a massive capital infusion. March 2009, investors were like, the share count, this is the share count. They don't need to dilute anymore, and the stocks went to the races.
Okay.
For the banks also to perform, I think market has to see how these banks will be able to raise a significant chunk of this $40 billion Anil, as quickly as possible.
Anil, since we're running out of time, if the government could, give a lump sum, say probably a 50,000 crore or a 60,000 crore in FY17 itself, if a big number is announced, do you think that that will make life a little easier to raise money from the equity markets? Would an upfront big payment work?
It should help by a bit. I don't think it will remove the problems completely, but it will help to a small extent.
All right. Anil, we will leave it at that. Take a break and come back. We will have Dr. Chakravarti joining us, and Anando Bhowmick will also be with us. Back in a minute.